повинна прокинутися.
Europe must wake up now. The largest nuclear power plant in Europe is currently burning.
As you can imagine, it is a very, very delicate situation where anything could happen.
Вибух.
If there's an explosion, that's the end for everyone, the end for Europe.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Europe's largest nuclear plant in East Ukraine comes under attack. The Ukrainian government says Russian forces now occupy the site. Wall Street is already pouncing on Russia's cheap corporate debt, while banks and hedge funds bid on bonds from Gazprom to Russia Railways. And stay with Bloomberg Surveillance Early Edition. This hour, we speak to the Lithuanian President Gitanas Nauseda. Send in your questions on IB plus TV Go. Now, first thing is first, let's check in on the markets. Now, we have seen quite a lot of volatility. We look at liquidity as well. Our Mark Cudmore had a great chart on liquidity, but we look at volatility because, of course, a lot of traders will have woken up to the fact that Russia was attacking a nuclear plant. Now, there was earlier a bit of confusion about whether it was uglier or could get worse than we thought. For the moment, of course, the fire has been extinguished, and we understand that it's occupied by Russian forces. And so we see a little bit of stability when it comes to the markets. European stocks still down some 1.7%. We did see a bit of a reversal when it comes to the futures in the U.S. because of that news. So if you look at S&P futures, they were actually only down some 0.3%. Again, that's on the back of the fact that we seem to have stabilized the situation at the nuclear plant. The other thing we're watching out for is, of course, U.S. jobs. Now, no one really cares about U.S. jobs that much, but still it gives us a good indication of what the U.S. economy is dealing whilst we, of course, freeze Russian assets. The other bigger story is commodities. We haven't seen a week in commodities like this in the last, I think, 30 years. So this will have implication for a lot of inflation update. And you can see the FTSE down some 1.3%. The FTSE maybe over in Italy down 2.5%. And is the CAC 40. So a lot to wade through when it comes to the markets. The implications, of course, on corporate bonds. A lot of corporate bonds from Russian companies that may not be sanctioned are going to be paid out, some of the coupons, in the next couple of days. We don't 100% know whether that money will reach some of the creditors or whether more sanctions are also to come. So we could see a potential default somewhere in the market. We're not saying it's happening, but something that, of course, we need to watch out for the second and third round effects. Now, Europe's largest nuclear power plant in eastern Ukraine has come under attack from Russian shelling, raising the stakes in Vladimir Putin's invasion as his forces bombard cities across the country. Now, Ukrainian authorities say the plant is now occupied by Russian forces.
Європа зараз повинна прокинутися.
Europe must wake up now. The largest nuclear power plant in Europe is currently burning.
Якщо буде вибух,
If there's an explosion, that's the end for everyone, the end for Europe.
Well, joining us now is Lithuania's President Gitanas Nauseda and Bloomberg's Europe correspondent Maria Tadeo. President, thank you so much for joining us. First of all, given the horrific images coming from Ukraine, the shelling, the bombing, can Ukraine prevail in this war?
I think Ukraine will prevail in this war because the fighting spirit and the spirit in the society is so strong. And I'm pretty sure that Ukrainians as a nation are united about his leader, Volodymyr Zelensky. And our duty is to assist them, to help them to be so strong as they are so far. And of course, Russia is desperate, and we see what Russia is doing. Russia attacks on civil nuclear facilities in Ukraine. This is a crime. This is just a crime, nuclear terrorism, and I call on international reaction. First of all, Atomic Energy Agency should react to what is happening there. And I have to remind you that we have at the border with Lithuania, so-called Ostrovets nuclear power plant in Belarusian territory. So we could become the nuclear hostages because this nuclear power plant could be turned into nuclear weapon too. So this is going far beyond the behavior we could call the behavior of normal human beings.
And Mr. President, just to, of course, you made a very severe statement just there. Just to clarify, what you're saying is that Vladimir Putin already is doing war crimes, and that what we're seeing, particularly around this plant, should be considered as terrorism. Is that what you're saying, just to make sure we get your words correct?
I can explain and I can tell very long sentences about what is happening, but I will call it nuclear terrorism, because it's indeed nuclear terrorism of what we are witnessing right now.
And the fact that this is nuclear terrorism, I mean, how does that make you feel? We know that yesterday Emmanuel Macron had a call with Vladimir Putin, and he came out of it believing that this situation is going to get worse in the next few days. So how can you deter further aggression? What we're seeing already is very ugly.
First of all, very strong response in many means, with all means. And first of all, we have to talk about even stronger sanctions on Russia. We have to stop to buy the oil and energy resources from this country. Lithuania is ready. Lithuania is ready to have alternative resources, alternative channels to buy crude oil from other countries, not from Russia. We are not dependent anymore on natural gas coming from Russia, because we have LNG terminal in Klaipėda established. So those are the measures we took in the past, and they help us to just to be a part of this anti-Russian coalition, because this behavior is absolutely not tolerable, and we have to do everything in our hands to stop, to prevent Russia. And of course, we should talk about full disconnection of Russian banks from the SWIFT system. So far, we implemented some selective steps, decisions. They are not sufficient. Secondary sanctions for those who violate the existing ones. And I would like to say that there are countries which might help assist Russia to avoid the primary sanctions. This is also the matter of our discussion. I hope that next week we will have an informal meeting of European Council in Paris. And I think the big part of our discussion will be dedicated to Ukraine and those recent steps, recent decisions of Russia.
How will the war be resolved? The sanctions so far have been swift, they've been aggressive, they have not deterred President Putin. Will he stop at nothing in order to actually take over Ukraine?
But we can do more. First of all, we have to assist Ukrainians to withstand in this fight. And of course, we have to take all the measures, military, finance, economic. But yes, I agree with you that so far, because of brutality and because of very cynical approach of Russian government, unfortunately, those sanctions didn't have that impact we could expect. But it does not mean that those sanctions are ineffective, and we have to continue, and we have to press Russia to put it to the corner, to isolate from every organizations in the world, cultural, sport organizations, and this is happening right now.
And you say isolate Russia, but the Ukrainians say that what we should do, or what the West should do, by that we I mean, is to make Ukraine a no-fly area with all the risks that carries. Of course, you have to enforce it. That means you'd have to have NATO planes flying over the country. Should there be a no-fly area over Ukraine? And if not, why are you not sending fighter jets for Ukraine?
This is a good declaration, but how to implement this declaration practically? If Russian planes will violate this non-fly zone, what will be the instructions on the ground? So this is the reason why we have to assist them with modern air defense systems. But we should very carefully consider to step into the conflict directly. I am talking about NATO, I am talking about Western world.
Is NATO, Mr. President, doing enough to reassure the Baltic countries?
Sorry?
Is NATO doing enough to reassure the Baltic countries?
I think we feel sufficient support coming, and not only in Ukraine, but also, as you mentioned, in Baltic countries. We see this support, and we see very decisive and immediate reaction. I recall the recent meeting of NATO summit in Brussels. I also see the efforts by Secretary General Mr. Stoltenberg to pay more attention to the whole region, to the whole eastern flank of NATO, because in the initial stage there were discussions about Baltic Sea region, not Baltic Sea, but Black Sea region. But now we are in the process of paying more attention and taking more measures to secure and
Mr.
to increase.
President,
Yep.
And Mr. President, you say we've got to pay more attention, but yesterday at 3 a.m. in the morning, Zelensky in his telegram, he put up a video in which he said, if Ukraine fails, the Baltics are next. I know this is a very delicate question, but do you fear for the sovereign integrity of your country? I know it's very delicate, but what Ukraine say is if we're down, the next is the Baltics.
This is exactly the message I'm sending to my colleagues, to the leaders of Western world. Yes, maybe those will be the Baltic countries, maybe it might be Romania or other countries of Eastern Europe, but this is absolutely clear that if Ukraine falls, there will be second target, and the third one, and so on.
All right, Mr. President, thank you so much for joining us. Lithuania's President Gitanas Nauseda, and of course our very own Maria Tadeo. Now, we're also looking at live pictures from NATO. We have a lot of foreign ministers coming in as we speak. We just saw minutes ago, there he is, Secretary Blinken, saying that, of course, the U.S. is ready to act if something were to happen in the U.S. We also heard from the German foreign minister. The markets, I guess, a little bit, more on tenterhooks, but less stress than they were a couple of hours ago. So U.S. stock indices futures still dipping as traders trying to assess the news out of Ukraine. Emergency services saying that a fire that broke out at a training complex at the nuclear plant had been extinguished and there were no injuries. We'll have plenty more, of course, on the situation on the ground and what it means for markets, business, and of course our economies as well. This is Bloomberg. Live pictures out of Brussels at NATO, where the meeting is just about to start with Mr. Stoltenberg. Of course, we heard him in a joint press conference, very brief, very to the point, with Secretary Blinken of the United States. Now, it does seem that NATO at the moment will not risk a border or broader Russia war. With, it's very difficult to impose, according to sources we've been speaking to on the ground, imposing a Ukraine no-fly zone. Now, the pleas, of course, out of Mr. Zelensky of Ukraine put the NATO in a very difficult spot, given its position that it's a purely defensive alliance. It has sent troops and equipment further east to reinforce countries close to Russia, but it's made clear that it will not send troops into Ukraine. We're, of course, keeping an eye on everything that's happening in Brussels and NATO. Now, to discuss the latest on the markets and on the economies, we're joined by Bloomberg's markets editor Christina Kino and Regina Borromeo, portfolio manager at Robeco's global macro team. So thank you both for joining us. Christine, if we do a roundup, so commodities have really been on a tear, and that has huge repercussions for inflation. I mean, the biggest commodity move in the last 30 years. Are you looking at that as, how much pain markets can get, or a possible default from a Russian sovereign or a Russian corporate?
Well, Francine, we have to keep an eye on all of these things for sure. Definitely. I mean, it started, of course, with the Russian assets on the ground and really getting a sense of how vulnerable they are at the start of this week. Then we moved on to the commodities aspect of it, because that has very big implications, again, for the broader inflation picture. This is part of the reason why we've seen bond markets, for instance, in such turmoil this week, because people are trying to make sense of that balance between growth and inflation. But now, Friday, we're turning to the FX market, because that's where the action is. We're just seeing interventions across Eastern Europe. Just before I got on set,
I know, with Czech and Poland. Let's also listen in to the Secretary General of NATO.
Opening of the meeting, and we will continue in just a moment. Thank you.
Okay, I cut you off, Christine, but actually it was just introductions. I mean, we are keeping a very close eye on this in case there's some kind of no-fly zone imposition. You're absolutely right. I mean, it's Czech and Poland, and basically there are three countries that have quite a lot of liquidity when it comes to currencies. Can they really defend them?
Well, Francine, that is going to be the big question. I think, again, any sort of intervention that happens right now will be a little bit like pushing a boulder up a hill, because they're going to be going against the tide of broad declines. I mean, this is something that we're seeing as well in the euro, for instance. We're seeing the euro this morning really extending those declines against a number of currencies, against the dollar, against the Swiss franc. And, you know, this really lays bare just how exposed Europe is to this crisis. We've already seen it from the commodities angle, of course, and just in terms of proximity, geopolitically is very, very vulnerable. And we're now seeing this kind of really being shown in the FX markets as well, where, again, some of the big three East EU countries, as well as the euro, really getting battered in today's session.
Yeah, and Regina, I guess it changes everything. I mean, which is why it's so, difficult to try and understand the second round effects or third round effects, what some of the countries close to Russia will have to do to defend their currencies. Right now, how difficult is it for portfolio managers to actually assess the fallout from freezing Russia and the Ukrainian war?
Well, first off, we're really saddened by what's happening in Ukraine and the humanitarian tragedy that's happening in the region. But as global portfolio managers, we have seen, some repricing in the global fixed income space. Volatility is up, obviously, with the heightened geopolitical risk. But even with this repricing, we are cautious in being overweight risk right now. And there's several reasons for that. First is because, we are still seeing the U.S. Fed triple tightening. The last time we saw this in the last cycle, this took about over 4 years, and we're going to see this happen in the next few months. Mm-hmm. The second reason is obviously the fallout that we're seeing in what's happening in the Russia-Ukraine war. And, we're seeing this in an additional supply shock, and that's flowing through to higher commodity prices, higher energy prices. And this is going to dampen growth, also affect, keep inflation high, and really raise the risk of stagflation across the EU. And the other, sort of risk that, we're concerned about too is obviously the other ramifications, the unintended consequences of the sanctions, of the freezing of the central bank assets, as well as the SWIFT bank ban
so, Regina,
in a number of the banks.
Yeah, so what you're worried about, could we see a default in either a Russian sovereign or Russian corporate? And again, what does it mean for people invested in EM? Do you close positions and get out, or do you stay invested?
Well, that was my last risk that we are closely watching in the next several weeks, is because, we could see a Russian sovereign default in the next several weeks. Yes, the central bank already stopped coupons for domestic holders, and there is an external debt coupon that's due in the next two weeks, about $100 million. So this could be an environment where actually for investors, it's a combination of what we saw in 2018 when the U.S. Fed tightened further by decreasing their balance sheet, but also what we saw in 1998 where Russia defaulted and we saw the collapse of the hedge fund LTCM. And on top of that heightened geopolitical risk that we haven't seen since the 1930s. So this dynamic is, yes, very challenging. There's going to be high volatility, but as a global value investors, there are opportunities, but we are being patient here. We are positioning closer to home in many of our different sectors within our global fixed income markets.
Regina, one of the things that we're trying to figure out is also the vulnerability of European banks, even possibly of U.S. banks, to the exposure of some of these corporates in Russia, or otherwise, some of the sovereign exposure as well. How long does it take for companies to have to come out with these disclosures? Are we talking about 2 weeks, or could we see something, someone big taking a hit in even a couple of months from now?
I mean, I think when you look at the non-financial corporate debt of the Russian corporates, it's about 1.3 trillion. So it's a decent size in a mix of both local and external debt. So the linkages there will take some time to flow through. So that's something that we are monitoring, because one is that you're going to have some volatility in the supply side, and then you're going to see the timeline of some of these coupon payments and debt maturities. I think there is a large maturity that's coming from Gazprom in the next week. So it's going to be interesting to see if there's going to be issues in repaying that external debt from Gazprom and more issuers from here. So, I think that's one of the reasons why, if you are an active investor such as ourselves, having large research teams in credit and high yield and on the macro side is quite important, because it is quite complicated. There's a lot of inner linkages and secondary effects to what we're experiencing today.
All right, thank you both for joining us. Our Bloomberg Markets editor, Christina Kino, and Regina Borromeo, portfolio manager in Robeco's global macro team. Now, as the West tightens sanctions on Russia in an attempt to choke off investor demand for its assets, parts of Wall Street are actually jumping in on the buying opportunity that it's creating. Bloomberg understands that Goldman Sachs and JP Morgan have been purchasing beaten-down company bonds tied to Russia in recent days, while both banks have declined to comment. Joining us now is Bloomberg's Laura Benitez. Laura, what roles are the banks playing here exactly by trading in debt tied to Russia?
Banks are acting as intermediaries, so they're buying and selling on behalf of their clients. In some cases, banks can also take on positions on their own books and package certain trades up and offer it up to clients to create opportunities. But I think it's safe to say that they're making markets at the minute.
So, given the war, of course, that going on, is there any risk, or how can there not be a reputational damage risk here?
Of course, there absolutely is, and I'm sure there's conversations within the bank, within the different departments and how they manage that. I'm sure one argument that the traders and the trading desk will make is that they're in some cases helping clients de-risk and sell their positions. Of course, we know that's not the case across every circumstance that we've been looking at. They are bidding for some assets as well, so they are selling that on to create some opportunities. But I think one argument could be for them is that they're helping some clients at least de-risk and remove some positions.
So, Laura, how much trading is actually taking place? How much do we know about that?
So we know yesterday JP Morgan traded around $200 billion alone, and we had similar amounts for Wednesday. I think a little bit higher on Wednesday, actually, 300 million, which is way above the daily averages prior to Russia invading Ukraine. So there's a lot of volume going through, and the names that we're seeing being bought and sold are things like Gazprom, Russian railways, a lot of sovereign debt as well is being bid for, and some other corporates as well. So it's quite wide-ranging. They're the main ones that we've been looking at.
So who's on the other side of this trade?
It's a good question. So we do believe from our reporting there are some big hedge funds stepping in. But obviously where that is still, a moving scenario, and we're looking into that. But as one fund manager in the story pointed out, this isn't the time to be looking for distressed opportunities, to be looking for opportunities at all. It's time to rip up that distressed playbook. This is a very difficult time. So I think the fact that hedge funds are stepping in is, creating a lot of questions. And it seems to be quite unsettling across the market for some.
All right, Laura, thank you so much. Great reporting, of course, from you and the team. Laura Benitez there, our European credit and high yield reporter. Now, in the meantime, let's also check back on the markets. We did see a bit of a wobble when it comes to U.S. futures. Stocks falling. U.S. futures also falling. War risks intensifying after this Ukrainian nuclear power plant briefly caught fire. Now, investors also await the monthly U.S. jobs report. The main question now is what happens to haven demand, apart from the possibility of Russia default either on a sovereign or corporate side, but Treasuries climbing amid this haven demand. Coming up, Russian forces occupy the nuclear power plant, so we'll get the latest on the ground. This is Bloomberg. Europe's largest nuclear plant in East Ukraine comes under attack. The Ukrainian government says Russian forces now occupy the site. Wall Street is already pouncing on Russia's cheap corporate debt, while banks and hedge funds bid on bonds from Gazprom to Russia railways. Plus, Eastern European central banks intervene in their currency markets. We'll speak to Goldman Sachs economist Kevin Daly. Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the market's definitely volatile this morning after traders tried to understand the situation in Ukraine with Russian forces taking over that nuclear plant. What we're looking at right now is a bit of stability when it comes to U.S. futures. The European stocks 600 actually in deeper territory. When you look at some of the things on the move, it's auto parts that are falling the most. Again, as the Ukrainian war escalates, traders really trying to understand what it means for havens. Treasuries climbing amid this haven demand. Also, oil set for its biggest weekly surge in almost 2 years. I'm also looking at the dollar ticking up and the euro slipping. Now, Europe's largest nuclear power plant in eastern Ukraine has come under attack from Russian shelling, raising the stakes in Vladimir Putin's invasion as his forces bombard clients across the country. Well, cities across the country. Ukrainian authorities say the plant is now occupied by Russian forces.
Європа зараз повинна прокинутися.
Europe must wake up now. The largest nuclear power plant in Europe is currently burning.
Якщо буде вибух,
If there's an explosion, that's the end for everyone, the end for Europe.
Well, we're now joined by Bloomberg's Aggie Cantrell, who's at the Medica border crossing in southeast Poland with the very latest on the ground. Aggie, what do we know?
Hi, Francine. So what happened at this plant yesterday was essentially that there was a fire in a training facility at the plant. They stressed that there was no nuclear part of the facility that was at risk from this. But now that the Russians have occupied it, it is important to note that this is something that's going to continue to be a concern to people as a country with 15 nuclear reactors is currently at war.
All right, Aggie, thanks so much. We'll have plenty more, of course, on the ground from Aggie Cantrell. Now, we're joined by Kevin Daly, co-head of CEMEA Economics at Goldman Sachs. Kevin, as always, thank you so much for joining us. We had a couple of minutes ago, of course, that story with the Polish Central Bank said to intervene to support zloty. I think we have a similar story, of course, in the Czech Republic. How much support do these currencies need in the shorter term?
Well, it's facing a very large dilemma. Each of these central banks have been very clear that they need currency strength to bring the already very high rates of inflation under control. The fact that you've seen these very dramatic sell-offs, depreciations in their currencies is making their task all the harder. You know, inflation, as I say, was already running at double-digit pace before this crisis. The combination of FX weakness and also, obviously, the very large commodity price increases will add to the burden of these central banks to bring inflation under control. So, you know, we think potentially quite material FX intervention going forward.
But Kevin, do they have the treasure troves to be able to do this? I mean, this is, you know, to be able to try and mitigate some of the excessive fluctuation. How much do they have to spend on this?
I mean, they do. I mean, they've ample reserves, and I think what you will see over time, in fact, what we are already seeing is further interest rate rises in response. Hungary yesterday raised the deposit rate more than was expected. We would anticipate that Czech and the Polish National Bank will implement further interest rate increases over time. We've as a result of the conflict, have raised our interest rate forecasts for these economies. So I think it will be a combined effect of both raising interest rates further than markets previously expected, but also intervening in the currency as well.
Kevin, I know there's not that many currencies that are actually liquid in the region, apart from these two and maybe the foreigns, but will it impact many more central banks and many more countries?
This is a very inflationary shock across, not only across the region, across the world. And bear in mind that we, our Russia economist in our forecast, we expect Russia GDP to fall by 7% this year. But that assumes that the export of commodities can continue relatively unconstrained. In the event that those are also cut off, then the hit to Russian GDP would be greater. The rise in commodity prices globally would be even stronger than we've seen already. So this is, is potentially very worrying for central banks. Bear in mind that even before this conflict escalated, they were already facing very high inflation rates, because of the impact of COVID. So, this is a double whammy for central banks across the region.
Yeah. Kevin, we're also just getting a briefing, which I think just started minutes ago, from the International Atomic Energy Agency. So we're keeping, of course, a very close eye on what they think the repercussions for this nuclear plant attack. We understand that, of course, the fire has been contained, but there was a lot of stress in the markets to try and understand if other nuclear plants are attacked, what this means. The IAEA chief briefing the press on this power plant. We'll keep a very close eye on what he's saying. Actually, let's listen in.
Nuclear power plant, where we have contacts at the moment and permanently through the night. So, as you have been informed, overnight, projectile hit a building within the plant site, within the site of the plant. This building, I should repeat, is not part of the reactor, is none of the reactors, is a training adjacent construction facility to the reactors. This caused a localized fire, which was extinguished by the local fire brigade at the plant. So it's important to say that all the safety systems of the 6 reactors at the plant were not affected at all, and that there has been no release of radioactive material. No release of radioactive material. Importantly, in this regard, is the radiation monitoring systems. So the systems we have to measure the radiation are fully functional as well. However, as you can imagine, the operator and the regulator have been telling us that the situation is naturally continues to be extremely tense and challenging because of the circumstances. Of the plant reactors units, one must say that of all the units that we have there, there's only one that is operating at around 60% of its capacity. Unit 1 was in outage for maintenance. Units 2 and 3 are in safety controlled shutdown. Unit 4 is the one that is still operating at 60%, and units 5 and 6 were already being held in reserve.
We'll continue, of course, following that press conference from the International Atomic Energy Agency to try and understand what the occupation of Russian forces on this site of the nuclear plant, as the fire has been contained, means longer term for the security of nuclear and the nation. We're back with Kevin Daly, a co-head of CEMEA Economics at Goldman Sachs. Kevin, I know it's extremely difficult to react, of course, to this nuclear plant situation, given we don't know at this point the ins and outs and exactly what it means for the control of energy. But if you look at that part of the world, is a market too sanguine that will be able to freeze out Russia, a neighboring country, the 11th biggest country in the world, without huge repercussions? What's the possibility of actually sanctions, firing back, especially for some of these smaller nations on the border?
Well, I mean, a major concern for us is that it isn't easy to see a near-term resolution to this conflict. I mean, on the one hand, even if the Russian forces win militarily in the coming weeks, and that's far from certain, but even if they do, their ability to maintain authority over a country of Ukraine's size and population will be very difficult. And yet, set against that, for the Putin administration to back down at this stage would involve a significant loss of face, of reputation and authority for him. So it's very difficult to see him backing down in the near term. So we are concerned that this, the crisis is likely, the conflict is likely to get worse, and we don't see any near-term resolution.
Kevin, going back to some of the foreign exchange intervention that we saw from Poland and the Czech Republic, I know you've put out new forecasts. Are they already out of date, given the situation is moving so fast?
I mean, the situation is moving very fluidly, as you say. The commodity prices, even in the couple of days since we've put out revised forecasts, commodity prices have continued to rise further. Exchange rates for the CE economy, so Poland, Hungary, Czech, have continued to depreciate, even in the face of the interventions announced today. We've raised our interest rate forecast. We expect a peak of 5.5% across the region. I think now that the risks are skewed very much to the upside relative to that, these central banks are likely to have to continue to raise rates and raise them significantly in order to bring both their currencies and inflation under control.
Kevin, thank you so much. Kevin Daly there, co-head of CEMEA Economics at Goldman Sachs. Now, we'll have plenty more, of course, on all of this. We'll have more on Wall Street, reportedly pouncing, also on cheap Russian corporate debt. That's coming up shortly, and this is Bloomberg. Kevin, thank you.
Thank you, Francine.
As always, thank you. See you very soon.
See you soon. Bye. Good luck.
Bye-bye. You too. Hi, Damien.
Hi, Francine. How are you?
I'm pretty good. How are you?
Good morning.
Thanks so much for joining us.
Anytime. Thanks for having me.
Isaac, I don't know whether we want to go back to... Hold on. To Aggie at some point. Al thought that the... Yeah.
That's better. I could just move this.
Yeah. Damien, thank you so much for waking up so early. Sorry, I'm not saying hi because I'm like distracted with the million pieces of news that's coming out. You saw intervention. We think there's been intervention by Poland and the Czech Republic in terms of FX, right?
Did they intervened in FX? Yeah. Okay.
Yeah.
I mean, I have actually, it's funny enough, I have a deck coming out in less than an hour where I basically highlighted that their currencies are getting smashed, so I'm not surprised.
Oh, that's interesting.
Yeah,
okay,
yeah.
Maybe we start there.
I mean, we could start, yeah, anywhere you like. I mean, for me, I think the real story that nobody's really covering, Francine, is the fact that a lot of countries which previously abstained back in 2014 when Russia annexed Crimea have actually, that voted no, have actually abstained this time.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. We continue following that press conference from the International Atomic Energy Agency. Of course, the head of that agency, the Director General, saying that Ukraine sent requests for immediate nuclear assistance to the IAEA. We understand for the moment that Russian forces are occupying that nuclear plant. The fire that had been started is now contained, and the IAEA has offered to mediate talks between Russia and Ukraine straight away. Now, you can continue watching that press conference on the Bloomberg terminal on LIV Go. Now, let's get more on our story. Also about Wall Street banks scooping up distressed Russian corporate debt. Bloomberg understands that Goldman Sachs and JP Morgan have been purchasing beaten down company bonds tied to Russia in recent days. Well, joining us now is Damien Sassower. He's our Chief Emerging Markets Credit Strategist at Bloomberg Intelligence. Damien, as always, thank you so much for making the time for coming in. When you look at that story about some of the possible defaults in sovereign Russia, in corporate Russia, but also now some of the currencies, including the Central Bank of Poland and the Czech Republic, having to intervene in currency markets, where's the biggest default? Like, what are you worried that could turn ugly in a short amount of time?
Well, I mean, to unpack it all, and there's plenty to unpack, Francine. I mean, we have to start this weekend. We're going to see some coupon payments from Gazprom and Rosneft. Yep. They're minor, but really, at the end of the day, that's the beginning. Gazprom owes a $1.3 billion principal payment on Monday. Look, the funds are supposedly at the settlement bank, ready to be paid. But we'll see if they actually make payment. I'm suspect on that one, and CDS is pricing in a very high probability of default either way. So, the reality is, looking at Eastern Europe, to your point, the interventions, I'm not at all surprised. Basically the Czech Republic, the Hungarian forints, the Polish zloty have all gotten absolutely smashed. The one safe haven within the CE4 has been Romania. The Romanian leal has actually tracked the euro quite well. So, it's still down, but not down nearly as much. So, I mean, if you then look at the Wall Street story and you look at JP Morgan and Goldman Sachs buying distressed Russian debt, look, that's a strategy which has historically proven quite profitable looking back to 98, looking back to some of the previous crises we've seen. Many of the largest emerging market distress funds today, Gramercy comes to mind, Greylock, which is, another one, they made their bones in 1998, Damien, picking away. So, yeah.
When you look back, okay, and you're right, let's take a step back because we're trying to unpack a lot because the story is so fast moving that if you're a trader, I mean, you either, hide under your desk or you try and figure out what happens next. First of all, if Gazprom, I think there's also Rosneft, having to pay a big coupon, in order for them to do that, they're not sanctioned. In order for them to do that, do they just need to have dollar reserves outside? Yeah. And is it possible that they have that, but it doesn't actually come to the creditor because of some of the, auto sanctions or just the sanction on some of the banking system? I mean, that's certainly possible. Obviously the mechanics of how that money actually needs to get paid to the underlying investors. But the money is offshore. It is there, and they can make the payment from what I understand. So, it remains to be seen what the mechanics are, whether or not a clearing bank is going to prevent them from doing that at this point, Francine. Okay, if a JP Morgan or a Goldman Sachs goes after some of this debt, given the toxicity and the fact that, frankly, Russia is now a financial pariah, is there going to be so much reputational damage that you're just going to have to banks saying, like, look, I can make a deal here, but it's just not worth it?
Well, I think really if they're acquiring this debt, they're acquiring it probably from other U.S. investors, right? I think really at the end of the day, we have to think about what this means for your ETF holder, your average retail investor here in the U.S. Russian bonds, Russian equities have been kicked out of every index on the planet right now. I'm talking JP Morgan, Bloomberg, FTSE, MSCI, equities, bonds, you name it. So what do you do? I mean, if these bonds are still sitting in a portfolio inside of an ETF, you have to ring fence it, and you basically have to create a different structure now. Whether or not you can sell those bonds through to the dealing bank or what have you remains to be seen. I'm assuming JP Morgan and Goldman Sachs are maybe putting a bit of that on their balance sheet, wearing a bit of the risk alongside their investors in the hope that they have a long time horizon, and this will get worked out in time.
All right, Damien, thanks so much. Damien Sassower, Chief Emerging Market Credit Strategist at Bloomberg Intelligence, actually stays with us, and we'll come back to him at some of the neighboring countries. I want to look at Poland, Damien, and I also want to look at the Czech Republic. In the meantime, we still have that important press conference from the UN Atomic Agency saying that there has been no radiation release at the Ukrainian plant. Mr. Grossi, of course, the Director General, also saying that they are apolitical and they have offered to meet Ukraine and Russia at Chernobyl. They also reiterated the fact that Ukraine had sent a request for immediate nuclear assistance to the IAEA. We now understand that Russian forces occupy the site of this nuclear plant, but the fire that really was extremely concerning to everyone involved is now contained. You can watch that press conference in full on LIVE Go. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Good morning, Francine. Commodities are closing in on their biggest weekly gain since 1974 as importers and shippers steer clear of Russian exports following its invasion of Ukraine. Brent crude briefly soared above $120 a barrel yesterday before pairing gains, while aluminium hit a fresh record and zinc topped 4,000. Now, wheat prices have soared to their highest level since 2008 on mounting fears of a global shortage. That's as a war in Ukraine shuts off over 25% of global exports of the staple used in everything from bread to noodles. Russia and Ukraine are also major suppliers of corn, barley and sunflower oil. Corn has risen to the highest level since 2012, while soybean oil and palm oil have also reached records. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Coming up later today on the U.S. Jobs Report, we'll speak with the U.S. Labor Secretary Marty Walsh. That's at 9:30 a.m. in New York, 2:30 p.m. in London, and this is Bloomberg. Now to talk about emerging markets, still with us, Damien Sassower, Chief Emerging Market Credit Strategist at Bloomberg Intelligence, and also joining us, Bloomberg's Markets Editor, Christine Aquino. So thank you both for joining us. Damien, first of all, you're doing a lot of research on something that hasn't really been noticed or investors have not had the time to look through, which is if you look at the UN Security Council and the countries that have abstained instead of voting no to a resolution, a lot of them, of course, are emerging markets. What does it mean for their long-term investability?
Right. No, there's a lot to unpack there also. I mean, Francine, what stands out to me is if you look at 2014, when the UN had a vote on the annexation of Crimea, a lot of the historically Russian-tied countries, I'm thinking Armenia, Zimbabwe, Sudan, Bolivia, Nicaragua, they all voted no. This time around, they abstained. So that's kind of a good thing and shows the world coalition coming against Russia. On the other hand, you've got countries like South Africa and India, which have abstained and didn't really vote yes. I mean, India, as we know, is one of the Quad. In fact, I think President Biden's scheduled to speak with him this weekend. So, Modi, I mean, this is his time on the world stage, and for them to abstain, granted, we know that they rely heavily on Russia for military. They're fighting a bit of a proxy war along the western border with the northwestern border with China. So, again, there's a lot to unpack, but South Africa really stands out. I mean, why wouldn't South Africa, this bastion of freedom on the continent, vote yes? And, there's a lot to unpack there also. I don't think we have enough time.
No, I mean, we could do actually a whole 1 hour, 3 hour show just on this. And Christine, the other thing, if you look at emerging markets, is a lot of them, of course, are either commodity rich or very dependent on commodities. Commodities in the last week, I think we've never seen anything like in the last 30 years.
Absolutely, Francine. And so you've already seen that process starting for investors trying to hunt for which emerging markets are really potentially set to benefit from this boon because, we're talking about investors trying to find any sort of haven within the EM space from Russia, trying to carve out some spaces where they could potentially get some gains here at a time when risk aversion is really at quite an astounding peak. And so, all of these kind of resource-rich countries very much getting the attention of investors.
Damien, we are 7 days into those sanctions and really trying to freeze out a huge G20 country. Who will suffer the most in terms of country?
Well, I mean, obviously,
apart from Russia.
Well, Central and Eastern Europe is front and center, and we've seen the currencies. We've seen the krona, we've seen the forint, we've seen the zloty all get smashed. I mean, that is front and center. Those are three of the largest, most investable countries in the emerging market universe. Obviously, the Baltics are in play as well. They have a lot of hard currency sovereign credit, which is at risk. Let's be clear. Belarus, Russia, and Ukraine combined over the last week alone, their U.S. dollar bonds have lost $24 billion in market value for their dollar creditors. I mean, that's a huge number. I mean, it's not on par with Argentina back when they defaulted, but it's pretty significant. So the losses are building. And what we're seeing, if you just look at options on the world's largest emerging market bond ETF, the BlackRock iShares, EMB, basically option volumes are through the roof. Tons of put buying, investors buying protection, and it's a big number.
In 5 seconds, are emerging market portfolio managers now changing their allocation?
I think they're just assessing the risk, Francine, to be honest with you, and I think that's where we are. I think it's basically a function of what comes next, and what comes next means we are seeing prices consolidate here. There may be a buying opportunity potentially.
Damien, thank you so much. Damien Sassower, Chief Emerging Markets Credit Strategist at Bloomberg Intelligence, and thank you as well, Bloomberg's Markets Editor, as always. By my side, Christine Aquino. Now, we're also looking, of course, at some of these Russian forces having occupied the nuclear power plant. We'll have plenty more on that. Anna Edwards, Danny Berger, Matt Miller. This is Bloomberg.
Europe must wake up now. The largest nuclear power plant in Europe is currently burning.
It is a very, very delicate situation where anything could happen.
It's one of those fratricidal situations that nobody, not even Vladimir Putin, should wish for.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Friday, March the 4th. Our top stories today. Ukraine says a nuclear plant in the east came under attack and is now occupied by Russian forces. The incident is raising the stakes in President Vladimir Putin's invasion as his troops pound cities across Ukraine. Stocks fall and futures signal more losses for Wall Street as the historic week in commodities also sends shockwaves around the world. And later today, the U.S. jobs report will be front and center. Bloomberg Economics expects a solid pace of hiring, confirming Fed Chair Jerome Powell's assessment that the labor market has plenty of room to withstand rate hikes. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards with Danny Berger here in London and Kailey Leinz in New York. Matt Miller is off today. And Danny, we should point out that fire referenced in that opening sequence, it has now been extinguished. It was in an ancillary building to the actual reactor in Ukraine that was hit during this shelling by Russian troops. We got comforting words also from the IAEA, but none of that enough to lift the negative mood, the negative sentiment, the risk-off mentality we have for European stocks right now.
Well, it is a jittery market, Anna. It has a lack of liquidity, and that's leading to these jolts that we're getting in markets. And look, Asian markets are no exception. This morning, Asia was, of course, up and trading when those headlines hit of the attack on the nuclear plant. In the span of just 30 minutes after the headline crossed, we saw the MSCI Asia Pacific Index dive 1%, again, in less than 30 minutes. So it was a stark reaction, ending the session down some 1.7%. Now, Hong Kong fared even worse. It also was fed into this very risk-off day, but also local problems there as well. The economy seeing really weak data, activity the lowest in 22 months, given that they're dealing with the worst COVID outbreak in the city's history. And when it comes to what's doing well in the Asian session, it's things tied to commodities like the Aussie dollar, the best G10 performing currency today. And so far this week, up 2% versus the dollar as those commodity prices look to book their best week since the 1970s. And finally, Kailey, I think it's interesting to mention the yen really not acting as much as a haven. It does feel like it's all about the dollar to help protect against these risks.
Yeah, Danny, that's absolutely right. The Bloomberg Dollar Spot Index at the moment is trading at its highest going all the way back to July of 2020. As for how the picture looks like for other U.S. assets outside of the dollar, it really has been a wild session, just like it was a wild session in Asia, as Danny was telling us about. You had futures down sharply on news of that attack on the nuclear plant in Ukraine. Then the news that the fire extinguished brought futures up actually into positive territory just briefly, but we were once again heading south with S&P E-minis down by about 0.8%. In the bond market, yields had broken below 170. We're back up around 178 at the moment, but still down the better part of 6 basis points on the day. When it comes to oil, that has been a lot of volatility really across the commodity complex over the last week or really weeks. Right now, WTI crude up 1.3%. We're trading around 109. We've been dancing around 110 on WTI for many days now. And then just pointing to Bitcoin trading in tandem with other risk assets, it is lower after a big drop yesterday, down 1.3%. We're trading around 41,500, Anna, but of course there's a lot of scrutiny about how cryptocurrencies may play a role in getting around sanctions when it comes to Russia. It's something we heard Senator Elizabeth Warren talking about in Senate Banking Committee hearings yesterday, Anna.
Yeah, absolutely. Something we continue to follow. Kailey, let's get to the European story because certainly jittery, as Danny described it, is appropriate. Very nervous European markets this morning, down by more than 4% on the FTSE MIB. Gives you a sense of how some of the more geographically peripheral markets are performing today. Down by 3% on the FTSE 100. And we don't necessarily have the strong support of higher oil prices to lift us higher in the London market, which is something worth noting today and something a little bit different to risk aversion days we've seen in the past, maybe. Some of the sectors, well, no sectors really in Europe doing anything very positive today. But one of the sectors most beaten up is the auto stocks, down by 5.6%. This is a sector, of course, that's struggling to cope with its exposure to Russia. The supply chain issues had already been an issue even before this war started. And now you add on top further supply chain difficulties and whether they should or should not be supplying to the Russian market itself. The euro, interesting to watch. Dollar strength has been the haven of choice today. Money into the dollar has been the real story. But 110.14 on the euro. So we are seeing some weakness coming through in the euro. And I'm increasingly reading stories about whether parity is back on people's radar. We haven't been down there since the beginning of this century. Could that be something that the market starts to talk about? I spoke to 2 guests this morning saying it's absolutely not their base case, not what they're thinking about right now. Brent crude, $111 a barrel. So such is the volatility this week, down at 98 at one point, up at 119 at another. Such volatility, but only up by less than 1% in today's session. But we are seeing substantial moves higher on natural gas prices. This is the European benchmark. benchmark up another 8.7%. Not quite at those highs, but not far from all-time highs on those natural gas prices, really reaffirming our focus on this as one of the key indicators of stress and, of course, economic worry and economic concern to come for Europe, Kailey.
Absolutely. We'll continue to monitor the economics today because we have a big economic event in the day ahead. Before we get there, though, in terms of politics, France will also be publishing its final list of presidential candidates, and Emmanuel Macron, of course, announcing he will seek another term. At 12 p.m. New York time, Apple will be holding its annual meeting of shareholders. But as for that big economic event, I think we all know what it is. We will get the U.S. jobs report for February at 8:30 a.m. New York time. Danny.
Kailey, let's start today with our top story, with Russian forces having occupied the site of Europe's largest nuclear power plant after an attack that ignited a fire at the complex. It raises the stakes in Vladimir Putin's invasion as his forces bombarded cities across the country. The IAEA Director General spoke earlier.
For the time being, it is purely Ukrainian staff running the operations there. What we have in this case, as we speak this morning at 10:45, what we have is in Chernobyl and in Zaporozhye, we have effective control of the site in the hands of Russian military forces.
From the Polish-Ukrainian border, we're joined by Bloomberg's Aggie Cantrill. Aggie, it seems that the fire has been extinguished, but bring us up to the latest state of play at this nuclear site.
Hi, yes, so as you say, the fire has been extinguished, and it must be stressed that this fire broke out in a training facility in the plant, and Ukrainian authorities have said that no nuclear material was affected by this fire, but it is now being reported that it was in the occupation of Russia. And what is the significance of this is essentially that we're seeing a country with 15 functioning nuclear reactors that is currently dealing with a ground war. This is something that President Zelensky said was a wake-up call to Europe, because should there ever be any issue with these plants during this conflict, that would not just be an issue for Ukraine, it would be something that would impact the entire continent.
Okay, just looking at images of the Zaporizhzhia nuclear power plant that has been shelled then by the Russians, resulting in that fire, Aggie, that you described, that you mentioned, and has been extinguished now. It was, as you say, rightly not in the reactor. It was in a training facility nearby. And we also should mention that we're being told there's no elevated radiation levels at the site. Can you tell us, though, in Ukraine more broadly, what is Russia's progress now? We hear a lot about the advance in the south, more so perhaps than progress around Kiev.
So this nuclear reactor is actually just is about 200 kilometers up the Dnipro River from Kherson, which is on the Black Sea coast, which is where Russia has managed to gain a bit of a stronghold, as well as obviously in the eastern separatist regions. But what's important to note now is that you see behind me, there are still flows of refugees coming into Poland and other Eastern European nations from Ukraine, because this is not just something that is affecting the Ukrainian military versus the Russian military. These are a lot of civilians that are now being affected by the conflict itself.
All right, great reporting from the Polish-Ukraine border. Thank you so much to our Aggie Control. And of course, we'll have more on Ukraine later this hour with our Marie Tadeo in Brussels. But first, we want to get over to Washington, D.C. President Biden spoke with Ukrainian President Vladimir Zelensky as reports of the nuclear plant attack emerged. Meanwhile, the White House is objecting to banning oil imports from Russia. Emily Wilkins, Bloomberg government reporter, joins us now from D.C. So, Emily, the administration is against this, yet you had the likes of House Speaker Nancy Pelosi yesterday saying that she would support a ban on oil imports from Russia. How stark is the divide between the White House and Capitol Hill?
I mean, there definitely is a divide. Let's just be clear, though. I mean, even though House Speaker Nancy Pelosi has said that she would be for the ban, this isn't where all Democrats are. So there's not like a complete divide between President Biden as well as congressional Democrats. And the White House explained it. We heard, yesterday they said that they just don't have the strategic interest in reducing the global supply of energy. They are very worried about that, what that would do to gas prices for Americans. Obviously, Americans are already dealing with very high inflation. And so that so far has been the White House's interest going forward in trying to really strike that balance between doing what they need to do in terms of sanctions, but also making sure that the impact on Americans is minimal.
Emily, there have been more sanctions put in place, though, as that one gets debated. But what is being done when it comes to direct support for Ukraine?
So Congress is currently talking about a $32.5 billion in aid. That was a request from the White House. And this has been a number that's gone up over time. We initially heard about $10 billion. Now we're hearing this $32.5 billion number. It's not clear exactly when that aid would pass, but we do know that Congress is currently working on a bill to fund the government by March 11th, so just next week. And there's really a strong bipartisan desire on Capitol Hill to do what can be done to help the Ukrainians at this point. And so while we don't know, of course, what the final number is going to be, how that's going to differ from the White House request, you're really seeing a lot of strong bipartisanship around this issue. You'll remember at the State of the Union earlier this week, a lot of bipartisan applause for lines from the president on assisting Ukraine.
Emily, thank you very much. Emily Wilkins, our Bloomberg government reporter there with the latest from Washington. Now, as the West tightens sanctions on Russia, parts of Wall Street are jumping on the buying opportunity that it is creating. Bloomberg's learned that Goldman Sachs and JP Morgan have been purchasing beaten-down company bonds tied to Russia in recent days. Both banks have declined to comment. Kriti Gupta, Bloomberg Markets correspondent, has more on this Bloomberg scoop. Fascinating story then, Kriti, which has both a financial and a political angle to it, perhaps.
It absolutely does. Well, think about the point of sanctions, right, Anna? The idea that you do have to actually kind of make these assets essentially uninvestable. That's the end goal of these sanctions. And it's kind of worked. Take a look at what some of those dollar bonds are doing for some of the major state companies where you did have a lot of those EM investors have a stake. They are now worth about 35 cents on the dollar on average. For a radio audience, essentially, it's a line and then it's a steep drop. It tells you just how quickly these moves have been made. And it's not just in the bond market where you did see JP Morgan actually say it's been working with about clients for about $200 million in corporate debt from Ukraine and Russia. But it's happening in the stock market as well, where you have these enormous moves when it comes to some of these ADRs for Russian banks. Gazprom, for example, the ADR is down 62% year to date. Lukoil as well, down 93% since the start of the year. And Sberbank, which of course is the largest consumer bank in Russia, now down 97% since the year started.
Some massive moves. Thank you so much to Bloomberg's Kriti Gupta. And of course, for our radio listeners, if you want to see Kriti's great chart, you can just type GTV Go on your Bloomberg terminal. Meanwhile, Fed Chair Jerome Powell reaffirmed yesterday that the U.S. Central Bank is on track to hike rates this month. He spoke before the Senate Banking Committee.
I would be recommending and supporting a 0.25% interest rate increase at our March meeting. If we don't see inflation behaving as we expect it to behave, which is to peak and begin to come down, if we see inflation behaving in ways not consistent with that, then we're prepared to raise by more than that amount in a meeting or meetings.
That was Fed Chair Powell speaking yesterday, and he and investors now are awaiting the U.S. jobs report out later on this morning. Michael McKee, Bloomberg International Economics and Policy Correspondent, here with us for more. Mike, what are we expecting?
Well, you know, with the news that you've been reporting this morning, people on Wall Street are saying today is NFP day. Not non-farm payrolls, but not focused on payrolls. And that's going to be the story of the day. With so much news going on over in Europe, the payrolls report isn't going to have much of an impact on a Fed that has already decided what it's going to do in March. We're looking for 423,000 jobs. It would tell the Fed things are still going okay in the U.S. economy. Unemployment drops a little bit. They'll watch average hourly earnings, but they know they have been going up as long as they don't go up much more than what we're forecast. This is the thing that people are going to be watching at the Fed, not because of the March meeting, but they want to know, when does the rest of America come back to work? Were people off work because they have been worried about COVID? And if so, has that drop off in the COVID case rate started to bring people back? And that's the participation rate that everybody is looking at. And we're looking to see if it goes up during this, if it went up during February. For those of you watching on radio, I have a chart here that shows the participation rate here in white is the prime age workers, the 24 to 54-year-olds, and that has been high. It's at 82. It's supposed to be, well, before the attack, it was at 83. That's 1.3 million jobs still left to return. The only category that's come back strong are the old guys, over 54. And we hope that the younger people will get back to work as well. And maybe next month we'll be paying more attention to the jobs report.
All right, NFP, not focused on payrolls. That's our acronym for today. Thank you so much to Bloomberg's Michael McKee. Now to get back to some of the micro stories, take a look at some stocks moving in pre-market trading this morning. A big one to the upside is Gap, of course, the retailer. It reported after the bell last night, better profit outlook for the year than expected. It says its strategic turnaround starting to pay off. That stock is up about 7.5% before the bell. Another upside mover is Raytheon Technologies. You're seeing defense getting a little bit of a lift with the war ongoing in Ukraine. It's up about 2%. To the downside, though, basically all of the cruise lines are lower in early hours, one of them being Carnival, which announced yesterday it is starting to change some of its itineraries to avoid the port of St. Petersburg. Not a lot of people, I guess, want to cruise to Russia at the moment, and especially given all the sanctions going on, it could complicate that situation. So that stock is down about 5% before the bell, Anna.
We just saw Mike McKee making a speedy exit from the studio. No doubt he didn't want to miss any of our next conversation, Kailey. We'll be talking to Steve Blitz, TS Lombard Chief U.S. Economist. Lots to discuss. We've heard a lot from the Fed this week. How much of that has cut through? How much will the payrolls cut through, given everything else we're dealing with here on markets? And thinking of the geopolitics, thinking of the tragic situation in Ukraine itself, we will talk to Wolfgang Munchau, Euro Intelligence President, here to talk us through all the politics as he sees it. Plus, on that jobs report, we will be speaking to the U.S. Labour Secretary later, Marty Walsh. That's at 9:30 a.m. in New York, 2:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance, the early edition. Now, earlier today, the Moscow Exchange reported that they would keep their exchanges for all assets closed at least until Tuesday. So you now have a market that is illiquid and untradeable and valued at zero. But what are the contagion possibilities? Well, we are starting to see signs of stress, specifically U.S. dollar funding stress. For a radio audience, I have the FRA OIS spread. Essentially, this is the spread between funding overnight versus 3 months. Usually, it's around zero. But the stress in this market means that this spread has widened more than 15 basis points on the week, getting to those 2020 levels. So how stressed out is this market? Let's get to Lynn Thomason, Bloomberg Markets Managing Editor. Lynn, how widespread is anxiety in this market currently?
I think anxiety is everywhere.
All right, I think we are having some audio issues. Apologies for the technical difficulties. We will be getting back to our markets conversation. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger with Kailey Leinz and Anna Edwards. Now let's get back to our conversation with Lynn Thomason, our EMEA Markets Managing Editor. Lynn, sounds all back on, so let's get back to it. We're just talking about anxiety in this market. Now that you are loud and clear, where are you seeing it most pronounced?
There we go. And there's plenty of the anxiety in the market. Where is it most pronounced? I mean, I think it's really across the board in all risk assets. You're seeing a flight to safety. And, you know, I think really the most remarkable move this week has been in commodities. Oil, agriculture, metals, all going through the roof on the Russian news. And, you know, it just seems like things are heading higher from here.
Right. OK, so commodities certainly has been a big focus for us this week. Also a big focus then, Bank of America and their latest data on where flows are heading and money coming out of Europe. I mean, you just have to compare U.S. futures down but not out with European stocks, which are substantially hit this morning, to see that in action.
Yeah, absolutely. And I think what you're seeing from markets is, you know, traders are saying, how are we going to trade this? And clearly, you know, Europe and the fallout from Europe, and what are some of the impacts? It's going to affect this region more than perhaps, you know, the U.S. and Asia. So you're clearly seeing European equities get the hardest, and that's being reflected in the outflow data.
Lynn, just quickly.
Lynn, thank you very much.
Sorry, Anna.
Apologies, just up against a hard break. But Lynn Thomason, thank you very much for joining us. Still to come on this program, Steve Blitz, TS Lombard Chief U.S. Economist, will be with us. We'll talk about everything we've heard from the Fed this week. We'll talk about the fundamentals of the U.S. economy. What data updates have we had this week on that front? And does that give Steve reassurance about where the U.S. economy goes from here, even if we see the U.S. economy's growth trajectory hit by what's happening in Ukraine, tragically on the ground? Does that mean that, where does that leave the U.S. fundamentals? We'll get to that conversation shortly. We'll also talk about the non-farm payrolls data, which is due to be released later on today. But with all that is going on in Ukraine, how will that cut through? This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Ukraine says a nuclear plant in the east came under attack and is now occupied by Russian forces. The incident is raising the stakes in President Vladimir Putin's invasion as his troops pound cities across Ukraine. Stocks fall and futures signal more losses for Wall Street as the historic week in commodities sends shockwaves around the world. And later today, the U.S. jobs report will be front and center. Bloomberg Economics expects a solid pace of hiring, confirming Fed Chair Jerome Powell's assessment that the labor market has plenty of room to withstand rate hikes. I'm Anna Edwards with Danny Berger in London and Kailey Leinz over in New York. Kailey, the European equity markets really preoccupied, of course, by everything that's been happening on the ground with that attack on a nuclear power plant. Some shelling by Russians of that nuclear power plant, and now the subsequent occupation of that power plant, a fire that there was on the ground there now seems to have been extinguished. But that's made European equity markets really nervous, really jittery, focused on the risks. Whereas US futures, yes, they're down, but not as substantially.
Not as substantially. That's exactly right, Anna. Of course, here in the U.S., we are also awaiting the February non-farm payrolls report in about 3 hours' time. But as our Mike McKee told us earlier, NFP today doesn't really stand for non-farm payrolls. It's instead not focused on payrolls because the geopolitical situation is really front and center. Now, futures at the moment are only down about 0.5%, so nowhere near the losses we are seeing in Europe at the moment. But it has been a very whippy session, as it seems that really with thin liquidity, each and every headline and the resulting move in the market is exacerbated. As for what's going on across other asset classes, the 10-year yield had broken below 170 earlier on in the session overnight. Now we're down about 5 basis points. 179 is where we trade. When it comes to the dollar, you are seeing that haven bid showing up there. The Bloomberg Dollar Spot Index is at its strongest, going all the way back to July of 2020. And then, of course, we've talked about the dramatic price action in the commodities complex. A lot of that has been in oil and natural gas, but it also has been in agricultural commodities, given that Russia and Ukraine really is a huge bread basket. Wheat futures are up another 6.6% today. $12.09 a bushel is where we trade. Wheat heading for the biggest weekly move, 40% on record, as those prices are at the highest since 2008. Now, as for some stocks moving in pre-market trading, you're seeing a lot of the travel complex under some pressure today. Cruise lines like Carnival and Royal Caribbean each down in the range of 3 to 4%. And big tech also is dragging broadly on sentiment. Tesla's down 0.8%. Apple by about 0.7 in early hours, Anna.
So that's some of the pre-market movers, Kailey. Let's get to the European picture then. And as we were just discussing, the moves here in Europe do seem to be more substantial than we're seeing in US futures. So European stocks down by 2.5% in this morning's session. Some of the big markets in Europe down by more than 3%, in fact, during today's session. The euro, 110, down by 0.5% against the US dollar. And a lot of people talking about just how low this goes from here. I talked to a couple of guests who were talking about 107, maybe 108. Not talking about parity, but we do have some interesting stories around about whether parity will be more coming into view as we go through the months ahead, given the European economy's exposure to what is going on in Ukraine and exposure to geopolitical tensions and to those economies themselves. This is the Brent crude price up by 1.6%, which by this week's standards, not such a substantial move. 112 is where we trade. This is the natural gas price, though, and this is where a lot of the politics gets really complicated between Europe and Russia, of course, because that gas is still flowing through that gas pipeline at much elevated levels. Kailey.
All right, the complicated politics of war, Anna. So let's have more on that war and the ongoing crisis in Ukraine and start with our top story, which is that Russian forces have occupied the site of Europe's largest nuclear power plant after an attack that ignited a fire at the complex. We now understand that that fire is under control. This raises the stakes in Vladimir Putin's invasion as his forces bombarded cities across the country. We heard from Ukrainian President Vladimir Zelensky earlier.
Європа зараз повинна прокинутися.
Europe must wake up now. The largest nuclear power plant in Europe is currently burning.
Якщо буде вибух,
If there is an explosion, that's the end for everyone, the end for Europe.
That was Ukrainian President Vladimir Zelensky talking about how Europe needs to wake up. Let's get more on Europe's reaction to this. Bloomberg's Maria Tadeo, our European correspondent, joining us now from Brussels. Maria, what are we hearing?
Well, Kailey, we know that there is a NATO meeting that is underway. And of course, the big question today is what should we do with that fire and how should we interpret the actions undertaken by Russia in what is a very dangerous move? I mean, this is a nuclear plant. And what NATO ministers said today is that at this point, Vladimir Putin is playing with fire. This is reckless and everyone needs to take a step back. Now, in terms of where we go from here, well, we know there's an active discussion going on behind the scenes that could potentially culminate today when foreign ministers meet after they meet with NATO. There's a debate around what to do with sanctions. A lot of the Eastern European countries say that the current sanctions, they may be powerful and we haven't seen the full extent because the Russian markets are still shut, but more is needed. And of course, the conversation is moving towards energy. I see many officials behind the scenes who tell me we need to really talk about a full ban of Gazprom, of also oil and gas imports from Russia. And if that means we need to burn coal at this point, we should be doing it. However, Kailey, remember, this is a decision that will have to be made unanimously by the 27 countries. And just very quickly, earlier we spoke exclusively with the Lithuanian president, who told us this situation is now not just about Ukraine, it's about the precedent that it could set to Eastern European countries and Baltics. And you can really sense that over the past 48 hours, because of the actions taken by Russia, but also the language coming out of the Kremlin and Vladimir Putin, they are increasingly concerned about spillover effects from this Ukrainian very tragic situation, of course.
Maria, more on that commodity market story, if we could. We see gas prices going higher again today, and of course the political conversation continues to focus on the extent to which Europe could do without Russian imports of gas, but the gas keeps on flowing. We keep seeing those daily headlines from Gazprom talking about how gas is flowing normally through the pipeline. I mean, the extent to which different European countries rely on this Russian gas is complicated and very divergent, and that could influence conversations on that front from here.
Yeah, very much. And Anna, as you know very well, the European market is different by nation. They all have different combinations of energy and they use different methods to, of course, heat up homes and have electricity running in their countries. So this is not a market that is compact in that sense. There's many different national variations. And yesterday we heard from the Germans who said we have to be real about the economic impact and the real politic of this. You can't just overnight switch up a whole system. We still need this gas. But of course, the flip side to this is countries like Poland that are so closely connected to Belarus, but also Ukraine, they feel the real concern from Russian aggression. And the Polish Prime Minister yesterday said, for me, the fact that we still work with Gazprom and Sberbank is completely unacceptable. And there needs to be a conversation as to at what point do we talk about blood money related to Russian energy. So, of course, this is still a very emotional issue, but you have the real practicalities of an economy that cannot switch overnight from one type of energy to another, and that is still incredibly reliant on years of course, Russian supply.
Yeah, I spoke to one commodities expert earlier who was saying it's things that are shipped around that have been subject to more self-sanction than the stuff that is piped. So far, not much disruption on that front. Maria, thank you very much. Bloomberg's Maria Tadeo with the latest on the European view, if you like, the geopolitics, how it evolves. Let us tell you, still to come on the programme, Steve Blitz, T.S. Lombard Chief U.S. Economist, will be joining us shortly. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Anna Edwards and Danny Berger in London. Well, it's jobs day here in America, and more favorable data are expected after weekly jobless claims fell more than expected. A strong report could underpin Fed notions that the labor market is solid enough to withstand policy tightening. Joining us now is Steve Blitz, TS Lombard Chief U.S. Economist. He is here with me in the New York studio. So, Steve, we already heard from Jerome Powell twice this week, essentially saying that a March hike is a done deal. Does this data today even matter?
No, it really doesn't. I think if it matters at all, it matters in terms of April or May, when the meeting afterwards. I mean, I felt like they were ready to go 50, and they had all the reason to go 50 in March, but obviously the war, equity market performance, they had to ratchet that back to 25.
So do you think that a 50 basis point move could be coming later, especially because this war you speak of in theory will lead to higher energy prices and amplify inflation?
Yeah, look, those types of higher energy prices were more likely to slow the economy, even if they give a boost to the inflation numbers. But there's big concern here is that the economy is going from this COVID boom to a long cycle. Right, and we're going from an asset inflation, and we could be starting an inflation process. In an inflation process, you have to, as the Fed, you have to get interest rates synced up sooner rather than later, and now's the time to do it.
Steve, good morning. It's Anna here in London. Now's the time to do it. An inflation process, that sounds like a very long-term challenge. How long, then, before the U.S. really gets a handle on inflation?
Well, there's two inflations here, right? So we know that the inflation from the COVID reopening is gonna fade here in the coming months. The real question is, where does the economy settle? And I've been saying for a long time it's going to settle at 2.5%, 3%. It's not going back down to the 2%. But the longer the Fed waits in terms of getting at least to 2.5% funds rate, it runs the risk of that 2.5%, 3% inflation rate not coming to bear and ending up with something higher. So it's really not about current inflation so much about where the economy ends up 6 to 9 months from now.
Do you find history at all instructive here, Steve? Do you dig out the history books to check out what happened in 1962 over the Cuban Missile Crisis, or go back to the 70s and look at higher oil prices? Do you find that's instructive in working out anything about the future direction for the U.S. economy, for that inflation narrative?
I wish it would, and we always want to sort of hang on to something like that. But this is just an unprecedented situation. I think the Russian invasion of Ukraine, though, and the prospect of more deglobalization and that type of global disruption does have a possibility to leave us with a higher inflation environment, because the low inflation we've had in the United States for the last 25 years is because we've had flat to falling goods prices because of trade and opening up trade and having a relatively strong dollar. That's probably not going to be the case going forward.
Steve, I really like this idea of whether history is instructive. And one of the things that I know I've heard that has been raised as an alarm are what commodity prices are doing. I mean, we've been talking about it here that, not every recession has been led by a 50% rise in crude, as Jim Bianco points out, but every 50% rise in crude has led to a recession. At the same time, the yield curve is just at a minimal 26 basis points. Do these kind of signals worry you right now, Steve?
Oh, absolutely. They absolutely worry me. I wasn't worried before Ukraine. Now it does worry me a little bit, simply because of the sharp increase in oil prices, as you say. But this is part of what makes the Fed's job very difficult, and why they're doing 25 and why they're tiptoeing through this thing, because they really. 50 would make sense. Look, it makes sense just to go to 2.5% on the funds rate right now. We know they're not going to do that, but it makes just as much sense to do that. Why wait? But all these things do matter. But I don't think the economy is going into recession. I think the markets are a little bit more worried than they need to be. And I think that the economy is doing quite well, and we'll see that this morning. Even if we get a 200,000 job number, those were great job numbers pre-COVID when you're sitting at 4% unemployment.
Well, this brings me back to one of your notes from earlier this week, and you were writing about sanctions and their impact on monetary policy, writing that how much of a difference it makes for monetary policy lies, as always, with the equity market. What do you mean by that, Steve?
Well, we're in an asset cycle. We're not in a credit cycle. And the historic times you've talked about before, that's exactly what we were in. We're in a credit cycle. And the linchpin for the U.S. economy really for a long time, but certainly over the last decade, has been the equity market. And the way the Fed conducts monetary policy, it is two avenues in which it impacts growth. One is through the dollar, and the other is through the equity market. And if you have a sharp decline in the equity market, it's going to impact spending, and it is going to slow growth. And that is the governor. I was joking before about the Fed going to 2.5%. That's the governor that keeps the Fed from acting as aggressively as it otherwise might want to.
Well, Steve, all we've done really is talk about aggressive Fed action. They haven't actually moved yet, and yet we've already seen financial conditions tightening. How much work has the market already done for the Fed?
Well, it's done a lot of the work, and they're very aware of that, and then part of their communication. I mean, the 2.5% by the middle of next year is there. But if they would front load that and move more rapidly to 2.5%, that does raise the short end faster. It's just the math in terms of the 2-year yield, right? So if they jumped 100 basis points, if they jumped to 2.5%, let's say in the middle of March, the 2-year probably goes up 100 basis points in yield immediately, right? Now, it maybe even doesn't do all that because then the market will start pricing in an ease. But in terms of just the straight mathematics of it, it would jump. And that's how being more aggressive early changes the dynamics of the market pricing.
Steve, would you expect the jobs report to cut through in the market psychology today, given all that we're seeing in Ukraine? Certainly here in Europe, it's the dominant theme. Looking at the way U.S. equity markets are set up, it might not be quite that way. It might not seem that way from New York.
Yeah, I don't think. Look, this number has to be a big outlier to the downside to really make much of a difference. And even if it's a negative, people will say, well, they'll look at the revisions to January. They'll think there's a lot of wacky seasonals going on. There usually is. So I'm not so sure that you've got. I think I'm very hard pressed to come. I'm sure there is a number that's bad that would have the market really jumping. But I don't think this number is really going to move the needle all that much.
Steve, thanks so much. Thanks for your time and so early. Steve Blitz, TS Lombard Chief U.S. Economist. We really appreciate you traveling into the studio this morning. Coming up on this program, we will, well, a little bit later, I should say, in programming, we'll continue to focus on that jobs report. We'll speak with the U.S. Labour Secretary, Marty Walsh. That is at 9:30 a.m. in New York, 2:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Anna Edwards and Danny Berger in London. And also joining us now, Tom Keene, co-anchor of Bloomberg Surveillance, who will be breaking down the non-farm payrolls report at 8:30 a.m. Eastern time. But Tom, is this one of the most inconsequential jobs days in recent memory due to the geopolitical situation?
It's an odd jobs day. I don't know if it's inconsequential. I think there'll be a lot of particularly inflation information in there as we game out inflation next week onto the Fed meeting. But certainly front and center is the war and the adjustment we're seeing right now, Kailey, in the markets. And I really want to emphasize food has a lot to do with this. Oil's always front and center for the Bloomberg world. Javier Blas makes us do that. But guess what? Wheat matters, and wheat's an extraordinary chart. Here's 6 decades of wheat back to the explosion of my ute, and then the explosion up here in 98 and the recent move upward as well. It really puts it into scale. And the heart of the matter here, Kailey, is the great food deflation we saw for a good 30 years.
Yeah, really fascinating, Tom. And we've been talking to analysts, Bloomberg analysts this morning, who've been pointing out, there's obviously the self-sanction goes on here, as in other commodities, but there's also just the physical difficulty of planting anything in Ukraine, of getting anything to the Black Sea, all of that very much in the mix. But I know overnight you'll have woken up to the news flow, as many of us here in Europe did, about this attack, the Russian shelling of a nuclear power plant. Important that everyone keeps level heads on this story. And with that in mind, I just saw one headline saying that there are very normal radiation levels coming from here. But the sell-off we see in Europe just shows how jittery we are around these headlines.
Well, it is a war within the new media, and it was such a shock last night. Again, this is the speed of the media that everybody's getting used to. And there you were with a video and literally bullets flying and all. That wasn't in previous wars. This is something new we're dealing with.
Well, Tom, to that point, with the fast nature of this and tail risks quickly becoming the base case, does forecasting the economy, the market, does it have any use in this type of environment?
A really important question, and the key thing there is flows. What I think I see on the screen right now, Danny, is we're having a balance sheet adjustment. We're doing that with the Russian markets closed, so we're not getting a true adjustment, but we're certainly seeing little quivers and movements here. I would really highlight euro testing a 109 handle as we speak.
Yeah, 110.01 at the moment, Tom. We are right on the cusp. What do you make of the dollar strength we are seeing?
Completely normal. It's completely what you'd expect. Also, yen dynamics as well. DXY out over 98 is a big deal. There can be a lot of analysis of intervention. Damian Sassower is truly expert at that, and ECB will be very, very important on it. But it's completely normal to see dollar strength here.
All right, Tom Keene, co-anchor of Bloomberg Surveillance. Looking forward to your coverage of the jobs report later on today. Thank you so much. But while we will be watching jobs, of course, we continue to monitor the geopolitical headlines. The situation when it comes to that nuclear plant that was attacked in Ukraine, we understand that fire is now under control. But Anna, as you say, causing ripple effects and jitters through very illiquid markets.
Yeah, absolutely. Illiquid markets. And we're just seeing some interesting headlines coming through, sticking with the geopolitics around Sweden, around Finland, two countries that are not NATO members, about polling that suggests that there's increased appetite to join NATO. So people are jittery, people are nervous, certainly in that part of the world. And that is leading them to look for a different path ahead, look for different alliances. But back to the markets, Danny, certainly you've been focused on a lot of on that lack of liquidity and those jitters.
Right. Well, look, we don't have Russian stocks trading until at least Tuesday. I am fascinated with this question of what it means if you are a fund in the U.S. and Europe and you hold Russian equities that you're mandated to get rid of, but you literally can't. You literally cannot sell them. We've had past experiences of this, be it Greece during the sovereign debt crisis or Egypt during the Arab Spring, but eventually those markets reopened and things settled. Kailey, I mean, it's this huge question mark. What happens if the Russian market never again opens to foreigners?
Yeah, I don't know if any of us know that answer to that question. But of course, while you can't really sell Russian assets, also people are acting as if they can't buy them either, even when sanctions aren't actually formally in place when it comes to things like Russian oil and gas, Anna.
Yeah, absolutely. The self-sanction we talk about quite a lot and certainly extends to many different asset classes. That is it for this hour of programming. More Bloomberg Surveillance, though, is ahead. They'll be having a conversation with Randy Kroesner, University of Chicago Booth School Professor of Economics and, of course, former Fed Governor. Interesting to get his perspective on the jobs report, how that cuts through right now. And, of course, team coverage of the situation on the ground in Ukraine, the Russian advance there and the humanitarian crisis. This is Bloomberg.